The current SGX tech rally is a valuation hallucination where share prices are sprinting miles ahead of actual earnings. If you are buying into these price spikes now, you are not investing in growth. You are providing exit liquidity for institutional players who already ran the numbers. You will walk away from this audit knowing exactly which counters are overbought traps and why only one name currently qualifies as a forensic sanctuary for your SRS capital. Most financial content is built around excitement. What is surging, what is breaking out, and what you might be missing. I am deliberately building something different here today. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. Let us look at the momentum driving the market right now. When you buy into rapid price spikes, you are taking on maximum risk just to hand the smart money and exit. That money entered months ago. For a retail investor managing their own retirement drawdown, your peace of mind depends on solid yield floors and cash generation, not price charts trading at over 100 times earnings. We need to move past the noise and examine the real dangers of chasing this kind of momentum. We see the green candles on the screen and the heart immediately starts to race. In May 2026, retail investors are flooding into local tech stocks, driven entirely by fear that the artificial intelligence train is leaving the station without them. But momentum is a fickle friend. When the headlines scream about record-breaking daily gains, they fail to mention that underlying profitability for many of these firms has remained completely stagnant for several quarters. Contrast the visual appeal of a rising chart against the cold reality of a quarterly financial filing, and the picture changes dramatically. It is time to look at how this plays out on the ground. In the heartland, we call this the wet market lobang effect. Just because there is a massive crowd pushing around a stall does not mean the fish is fresh. It usually means the noise is loud, and the uncle selling the loudest is not always selling the best sotong. For a 55-year-old investor in Bidok managing an SRS portfolio, chasing a stock that has already run 500% in a single year is not an investment strategy. It is a gamble with your retirement peace of mind. And unlike a bad plate of char kwai teo at the hawker center, the financial consequences of this kind of mistake do not just pass by the next morning. Let us examine where the math actually breaks down. The illusion of the tech boom becomes obvious when you trace the disconnect between share prices and actual revenue. Current market sentiment is being driven entirely by global artificial intelligence hype, but Singaporean tech firms are not all created equal. While the price moves might look like a Silicon Valley story, the structural cracks in their balance sheets tell a different tale. This is exactly where the dividend math breaks down. When a stock price triples but the dividend stays flat or microscopic, your yield on cost is being decimated. You are no longer compounding your wealth. At best, you are treading water. At worst, you are drowning. We have to look past the shiny exterior to see the financial strain underneath. We are looking at a classic HDB lift upgrade situation. The exterior looks shiny and new, but the mechanicals inside are under immense strain from the high interest rate environment. Retail investors see the gleaming new facade and assume the whole building has been renovated, but the pipes are exactly the same pipes. Our stress test scenarios show exactly what happens next. If the global artificial intelligence narrative cools off, we will see massive sell-offs and valuation compression, a 20 to 30% capital loss in weeks. If rates stay higher for longer, net margins get squeezed by debt servicing, leading to dividend cuts. And when the semiconductor inventory glut returns, cash flow turns negative, eroding your SRS principal. We must audit these debt burdens closely. Before we look at the hype, we must decode the actual financial health of these companies. This is a massive yield trap alert. Looking at our financial health checklist, most of the current SGX tech darlings fail the 4.7% minimum yield hurdle decisively. We are talking about yields so low that your CPF ordinary account money sitting safely at 2.5% is actually doing more work with significantly less risk. Under my forensic zone system, only Venture Corporation passes the health gates, securing a conditional Zone 3 rating. AEM Holdings, Nanofilm, and UMS Holdings all fall straight into Zone 4 caution territory. They fail our hard gates on valuation and yield. Let us look closer at one of these extreme valuations. Not every stock deserves the same level of trust with your retirement capital. My forensic zone system gives every counter a clear classification, from Zone 1 Fortress, which is the highest standard of safety, all the way down to Zone 5 Red Zone, where the structural damage is severe enough that I do not consider it suitable for any drawdown portfolio at any price. Zone 2 Watchlist means the yield and balance sheet are sound but worth monitoring closely. Zone 3 Conditional means the yield clears the hurdle but soft flags have emerged. One more earnings cycle before I commit. Zone 4 Caution is where yield falls below 4.7% or a hard gate fails outright. Speculative territory, not income territory. The zones are not opinions. They are the direct output of applying the same hard gates and soft flag count to every name I cover. No exceptions made. No sentiment allowed in. When you apply the forensic zone system to the 4 names in this audit, the picture becomes very clear very quickly. Venture Corporation is the only name that clears the yield hurdle and passes the balance sheet health gates. It lands in Zone 3 conditional, which means it is a viable holding but carries soft flags that warrant monitoring before adding to a drawdown portfolio. The other 3 names, AEM, Nanofilm and UMS, all fall into Zone 4 caution. That is not a close call. Zone 4 means either the yield has failed the 4.7% minimum hurdle decisively, or a hard gate has broken down on the balance sheet, or both. For a Singaporean investor managing SRS or CPF funds, Zone 4 is not an entry signal. It is a standing instruction to stay on the sideline and let the valuation compression do its work first. One sanctuary in a 4-name field. That is what this rally actually looks like when you strip the momentum out of it. Look closely at the price-to-earnings ratio for AEM holdings sitting at a staggering 135.4 times. You are paying for 135 years of current earnings just to own the stock today. In the heartland, if an uncle asked you to invest in his bak chor mee stall but said you would only see a profit in the next century, you would walk away before he finished the sentence. Why do we treat the stock market differently? High multiples without explosive revenue growth are not ambition. They are debt-fueled hope wearing an expensive shirt. Do not let a green chart blind you to the fact that you are buying a very expensive piece of air. We have to ground ourselves in the arithmetic of cash flow. The wealth check always comes down to yield and cash flow. Asset yield minus the risk-free rate of 1.40% equals your risk premium. For this audit, I apply a conservative stress test floor of 3.2% because we audit for the storm, not just the sunny day. While the 6-month T-bill sits at 1.40%, I do not lower my standards to match a temporary market dip. My floor stays strictly at 3.2% to ensure sanctuary assets can withstand long-term average interest rates. The minimum yield hurdle is therefore 4.7%, the floor plus 150 basis points of mandatory risk premium. Let us apply this arithmetic directly to the sector. Here is what that arithmetic looks like in practice. AEM yields 0.18%. Nanofilm yields 0.44%. Your risk premium is deeply negative. You are taking massive equity risk for a return significantly lower than the risk-free CPF special account rate of 4.0%. This is the definition of a yield trap. Think about what that means for a 60-year-old in Toa Payoh drawing down SRS funds. Every dollar deployed into a zero-yield stock is a dollar not working in a forensic sanctuary. And that leads to a shortfall when you need it most. Our peer comparison table shows the reality plainly. A EM faces a projected 33.4% correction just to reach its forensic fair value. That is a structural repricing, not a dip. Let us look at a safer alternative. Venture Corporation is the sanctuary in this space. Venture holds more cash than debt on its balance sheet. While other tech players are being squeezed by interest rates, Venture is earning interest on its massive cash pile, a structural advantage that most retail investors overlook because it does not show up in a price chart. It has maintained dividends for 34 years. Safety has its own compounding logic, and Venture understands it perfectly. That kind of consistency is what you actually need, not a speculative double that evaporates before the next dividend cycle. Protecting your capital takes discipline, and you need the right tools to do it. You really should not be reading this alone. In this current market, the difference between finding a true sanctuary and falling into a yield trap is often decided in a single trading session. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next setup together in real time. They do not just get the report earlier, they get the full forensic picture, the zero-day breakdowns, and the complete red zone watch list before the market even opens. For 9 Singapore dollars a month, which is less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. It is time to protect your capital together. Let us look at the final verdict. The bottom line is clear. The majority of the SGX tech rally is a pure momentum-driven phenomenon that ignores fundamental solvency entirely. For a 58-year-old investor in Jurong East, managing an SRS drawdown portfolio, chasing AEM or UMS at these elevated prices is a high-risk move that could produce a 20 to 30% capital impairment before the next earnings season even delivers the reality check. Patience is your greatest asset right now. Let the fear of missing out crowd chase the peaks. A forensic investor waits for the fair price house brand price quality assets at a sensible discount. When the markdown comes, and it always comes, you want to be the one with capital available to act. Venture sits in Zone 3 conditional. AEM, Nanofilm, and UMS all fall into Zone 4 caution, completely unsuitable for drawdown portfolios due to microscopic yields and severe valuation risks. Protecting your retirement means avoiding these hallucinations and holding firm to a strict stress test buffer. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. This analysis sits behind a 7-day embargo window, but Iggy's elite investors are already reviewing our next target. Hit the link in the description to join us. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.